It's nice to be here with my good friends from the Worcester Business Journal who've orchestrated this morning's what I know will be a very thoughtful and thought-provoking presentation. It's wonderful to not just see you all here, but also see you on a year that perhaps there's some good coming down the road as opposed to last year when we skipped it because we weren't sure whether there was anything good at all coming. First of all, I'd like to recognize the sponsors for the day. The presenting sponsor is Nichols College, and I want you to know that we couldn't put on events like this without the support of the people who are the sponsors, and I want to recognize in particular the people from Nichols College and invite someone up in a couple of minutes. But let's give them a round of applause. We have also a corporate sponsor in Bolus Lynch. Mike's here with us. And our media sponsor is WTAG. So we thank all of those sponsors for a wonderful morning. Now, without further ado, I'd like to introduce Rayanne Druin, who is Director of Enrollment and Marketing for Nichols College, to say a couple of words.
Good morning. It's my great pleasure, on behalf of Nichols College, to welcome you to what is sure to be an interesting and informative morning. I'm very excited to see so many successful business people from our region gathered here to listen to an amazing panel of experts. Nichols is proud to sponsor and be part of this unique event that enables professionals from Worcester County and beyond to meet, network, and discuss the many economic issues and important changes that are taking place in all areas of industry, business, and commerce. As a business school, Nichols strives to deliver the essential tools to help students succeed in an ever-changing global market. This morning, we are very proud to have several of our best and brightest undergraduate students here to learn from our panel. Each and every day, we turn on the TV, open a newspaper, flip through a magazine, or surf the web. We are barraged with information about the state of our economy, whether it be local, regional, national, or global. And for many of us, understanding how we fit into the giant jigsaw puzzle that is the economy can be a daunting task. However, one thing is very clear: the quality of the decisions we make every day can improve drastically with a better understanding of the present economy and where it is headed. Many thanks to the Worcester Business Journal for putting together such a great event and helping us all become better informed citizens and voters. Thank you.
Thank you, Rayanne. And what I might mention is we are going to have a Q&A at the end of the session, and there are small cards in front of you. If you have questions, would you write them down, and they'll be collected for the end of the session. I know Peter will mention that as well, but now it's a great pleasure for me to introduce a member of my board of directors, and that's Peter Stanton, who is the publisher of the Worcester Business Journal. And Peter, it's been wonderful working with you on this, and we look forward to a very, very insightful morning.
Thanks, Dick. You know, I just want to mention the second thing. Dick mentioned these little white cards, and we did this a couple years ago where folks who have, you think of questions as the speakers are up here presenting, and we'd like you to write those down, and those are going to be collected, and we'll use those during the Q&A part of the session. The second thing on your tables, we took the opportunity to print all our sponsors' logos again, and also, which is always a nice thing, there's a little contest here, and we would like to have everyone, what you learned this morning, have you become an economist and predict where the Dow Jones is going to be GDP growth, national and state unemployment. So there's a little cheat sheet here that says what they've been recently. And you're going to learn a lot from all of our speakers. So we're going to have a contest, and next year we'll present some nice awards for everybody who shows up again next year. But we'd like you to sort of take your shot at where things are going to be going this year. And you can do that as we go. You don't have to do that up front. So I'm going to invite, even though it makes seeing the slides a little tough for each of them, I figured we would invite our entire panel up at first, even though we'll hear from each of them one at a time, and we'll handle the Q&A all at the end. So let me invite up to sit at the table here in front of a microphone, Jeff Fuhrer, the Executive Vice President, Senior Policy Advisor of the Federal Reserve Bank of Boston. It's going to be our first speaker. Jeff, come on up. Fred Eppinger, the President and CEO of the Hanover Insurance Company, and Tim Warren, the CEO of the Warren Group and publishers of Banker and Tradesman. Okay. So let me start. I'm going to start by introducing Jeff, who will be our first speaker. Jeff Fuhrer is the Executive Vice President and Senior Policy Advisor at the Federal Reserve Bank of Boston. He's an Associate Economist of the Federal Reserve Open Market Committee and regularly attends this key U.S. policymaking meeting with the bank's president. In June 1992, he joined the bank's research department as an Assistant VP, an economist, and from 1995 to 2001 headed its open economy macro international section. Jeff has steadily climbed the ladder at the Boston Fed. In 2000, he was named Senior VP, Monetary Policy Advisor. In 2001, he became Director of Research, and in 2006, he was named Executive Vice President. He hasn't had a promotion in 4 years. What's wrong? No. A Princeton undergrad with a PhD in economics from Harvard, Jeff has been active in economic research for more than 2 decades and has served as an associate editor for the American Economic Review. Jeff has published numerous scholarly papers on the interactions among monetary policy, inflation, consumer spending, and asset prices. Despite his youthful looks, he's been married for 30 years and has 3 grown children and makes his home in central Massachusetts. Before I hand the podium over to Jeff, however, I want to say for myself and for the Chamber, we're really appreciative to have Jeff with us here this morning to speak. For those who've seen him present in the past, I think you'll all agree he does a terrific job at making lots of complicated data understandable. However, I do want to point out one little snag, sort of technical snag we had behind the scenes. A week ago, we asked everyone to send their slides in early so that we could be organized, and it was during that unending snowstorm, and we requested that presenters send them in. So we had a problem with Jeff's PowerPoint that arrived, and here is what we received. And I think if you can see, that's Jeff right up in front of his driveway. There's Jeff with the shovel, and you'll actually notice that the curve of this bank is GDP from 1974 through 1992. That's the exact curve. However, we straightened out the slides and we put them back in shape today. For those in the audience who were here last time as Jeff presented in Worcester, it was in February of 2009, and I'm sure we all remember the nation's economy was in free fall. The stock market had collapsed, and there simply was not a silver lining to hold on to. And Jeff's presentation was bracing with all kinds of steeply spiked, downward trending lines. And just to remember how dark that day was, I have a couple photos from the event that were taken of the audience and the panel as Jeff presented. And these pictures elicit the 2 most natural emotions when facing a complete disaster: tears and laughter. So it was a memorable morning a couple years ago. Today, in less turbulent economic conditions and less turbulent weather conditions, we're happy to have Jeff Fuhrer back at this annual event to give us his view of the economy. Without further ado, Jeff Fuhrer.
Thank you for that introduction, which was both funny and probably more informative. You know more about my life now than anyone really needs to know. I did want to start by telling you where I fit on this map of emotions, because that's important. I will tell you that, number one, I am exhausted because the last 3 years have been an incredible economic ride, especially for folks involved in trying to design policies to make things a little bit better. So I am exhausted, and I'm somewhere between cautious and hopeful. So that's good, because a little while ago I was both confused and frightened. So I have improved on that scale. I also wanted to say, I think Ray described the economy as a jigsaw puzzle. I actually know how to do jigsaw puzzles. I wish it were as simple as a jigsaw puzzle. It's really quite complicated, and we've learned to be humble over the past few years because there are many things that we don't understand as well as we'd like to. I also want to say that, I don't know if you can see this, I have this injury on my head. People think that being an economist is a very placid, desk-bound job. It's not. It's not that easy. I actually got this wound defending the value of the currency. I was caught between the Scylla of deflationary forces and the Charybdis of rampant global commodity inflation, and, you know, so I got this head wound. So, sure, that's what happened. Okay, actually what happened is an icicle hit me on the head as I was clearing, it's true, I was cleaning snow off my roof. So it shows you how bright I am. Anyway, so to preview what I'm going to say, the economy is now growing, which is great. We had 3.2% growth the last quarter of last year. That was really good to see, and there was serious growth apart just from what was happening with inventory, so that's terrific. We are now creating some jobs, a little bit slower than we might like, but at least we're making jobs. I'll come back to that more. There are still a number of high-level challenges that are facing the economy, in my view, and I've listed some of them here, and we'll go through them in the slides. Unemployment is foremost among those. It is still high. It's come down a bit in recent months. I'm going to talk about some of the details of that. That's important. One of the implications of pretty darned high and persistent unemployment is that inflation, despite what you read in the newspapers today, is pretty low and is likely not to ramp up. We'll talk about the effect of commodity price inflation as we get to that part of my slides. But I think the concern at the moment is inflation is probably undesirably low. 4 or 5 years from now, lots of things could happen, but for the next few years, not so much a concern. The residential sector, and Tim will talk about this in more detail, is still challenged. It's not obvious that there's a dramatic recovery going on there. There are some initial signs in some markets of things looking a bit better. The other thing that's really important is that the recovery we've had so far has been largely sustained and propagated by government support of one type or another. And some of that support is appropriately diminishing. That transition from a publicly supported to a privately supported recovery, we think we see that happening, but there's still some risks there. And the rest of the world is an interesting case, and I'll talk briefly about that as well. So first, let's just talk about employment. And what you can see in this chart, so the red and the black lines show you the average employment growth over the last few months. So there's a line that has a 0 next to it on the left-hand side. That means if you're below that line, you're declining. The good news is we're not declining anymore. We're actually adding jobs. The average over the past few months is in the neighborhood of the number of jobs we need just to kind of keep pace with the new folks who are graduating from school and entering the labor force and so on. It's about that pace. Obviously, if we want to see the unemployment rate decline significantly, we need jobs to grow somewhat faster than that. The green line is just showing you the initial claims for unemployment insurance. Those are folks who were recently become unemployed and are now filing to get their unemployment benefits. And the good news there is that line has come down from its serious recessionary peaks, and we had a piece of data yesterday morning that said it's gone down even a little bit more. So fewer people entering the ranks of the unemployed. That's one of the two pieces we need for the improvement in the unemployment rate, obviously. Fewer people going into the ranks of the unemployed. What we need, obviously, also is people leaving the ranks of the unemployed to find jobs. And as I said, we've got some of that. We'd like to see it a little bit faster, but at least we're doing better. The unemployment rate is still high. It's at 9% today. I'll talk about the details in a second. 9% today, but these are some famous macroeconomic forecasters, private forecasters. The key thing to take away from this chart is that the rate of decline in the unemployment rate is gradual from both of their perspectives. Slight differences in the forecast, but that's the same basic story. A slow decline in unemployment. I just penciled in for you at the bottom of the chart, what is a normal functioning economy? What kind of unemployment rate goes with that? It's hard to know. We'll talk about some changes in that over time, and there are people who are worried that we'll never get back to 5 or 6% unemployment. I don't think that's true. So my estimate is that somewhere between 5 and 6%, 6.25% at present, a little bit lower than that in the long run, just so you know where it is we're headed for, we're trying to get to have a fully functioning economy. So why is it that the unemployment rate is high and may remain that way for a while? Well, what I've shown you here is what has growth looked like for GDP on average in all of the economic recoveries since World War II. Those are the green bars. And what does growth look like since the beginning of this recovery, which the folks who determine that say started in June of 2009, so about a year and a half ago. So what does growth look like normally? It's 5, 6, 7%, right? That's a very normal kind of a growth rate for an economy that's starting to recover from a serious recession. What we've had are numbers that are significantly lower than that. And looking forward into the next couple of quarters, you know, we're seeing numbers that are more like 3% or so. So it's good to have 3% growth because it implies that we may gradually eat away at unemployment. But to see really significant progress, we need sustained growth of well above 3%. So I'm hoping that's in the offing. There are signs from the most recent data that may be happening. We may see growth rates like 4% for the next quarter or two. Hopefully that will be sustained. And if that's the case, we'll see more rapid declines in unemployment. That's obviously exactly what the economy needs. I did want to point out that if you follow these data closely as I do, how many of you read the releases from the Bureau of Labor Statistics every one person does? We'll talk later. So this is my job and it's my passion. But if you follow the statistics, you'd see that in the last 2 months, each of the last 2 months, the unemployment rate declined by 0.4 of a percentage point. That doesn't sound like a lot, but every percentage point on the unemployment rate is 1.5 million people, roughly. So 0.4, that's a serious amount. That's 600,000 people for each of those decrements to unemployment. So that's good. What I'm showing in this chart, though, is that part of what happened at the same time is that the unemployment rate fell not so much because we had a rapid employment growth, but because a significant number of people gave up looking for jobs and left the labor force. They're not counted in the unemployed because they're not in the labor force anymore. So I think we'll probably see a slight uptick in the unemployment rate in the next month or two. Not dramatic, but a slight uptick because some of that decline is due to people who are discouraged leaving the labor force. What we really want to see is people staying in the labor force, finding jobs at a greater than 100,000 a month pace. That'll be a sign of a really healthy economy. I think we're on the verge of that, but it's still, you know, a little bit precarious at the moment. Okay, as I suggested, there are folks who say today that, hey, you got 9% unemployment, that's too bad, you're just going to have to live with that because the economy has changed so much, there's so much structural upheaval. Folks who are in construction and finance are never going to find jobs again. There's mismatches in the people who need jobs relative to the jobs that are available, both in terms of the skills they have and the skills that are required in the jobs. There are mismatches geographically. Folks may want jobs who live in Las Vegas, but the jobs are actually on the East Coast or the Northwest. What I'm going to tell you is that the evidence on that, I'm just going to show you some evidence. We've looked at an enormous amount of evidence. The evidence in the actual labor market data, person by person, is not consistent with that. There is some structural upheaval, but the idea that we should live with an unemployment rate of 9 or higher percent is not only wrong, it's misleading for policy purposes. We don't want to convey the impression that policymakers should be content with a 9% unemployment rate. Now, so here's one way of looking at that. So this is a survey of the National Federation of Independent Businesses. So look at the green line first. It says, how many people respond that one of the biggest problems today is that there are few or no qualified job applicants? So they say that. There are some folks who say that. But that was a serious problem back in 2005, 2006, and 2007. Today, it is a much less serious problem. That is, in the wake of the recession, the idea that folks don't have the qualifications that they need for jobs, there's always some issue about that, but it is less so today than it was prior to the recession. So that doesn't seem like an argument for structural unemployment. What is the single most important problem? And the corollary to that is why is it that firms are not hiring dramatically yet? The answer is that's the red line. The single most important problem is poor sales. Right? Poor sales and the poor expectation of sales. Obviously, firms who don't see stuff flying out the door or don't see the prospect of that happening over the coming year are more reluctant to hire people. That's reasonable. That seems to be the more important issue, and that line has risen dramatically both during and in the wake of the recession. So again, this is not to prove things. I just want to say that's evidence, and we've looked at much more that suggests structural unemployment, yes, probably some, but nothing that would get you to 9–10%. The other thing that's important to recognize is that this was not just a recession in construction and finance, not even close. This is showing you all of the major categories that the Bureau of Labor Statistics follows, which are basically all of them for the economy. And I don't know if you can see, yeah, I think you can see the lines on there. The point is that for pretty much every industry, with the exception of the government and with the exception of healthcare, there were at least 5% declines in employment from the peak of the last recovery to the trough of the recession. So really significant declines in pretty much every industry. That's not, it did start off as construction and finance, of course. It spread to every sector. That is a widespread decline. It's not just a question of a structural reallocation in the economy from one smallish sector, finance, real estate, to all the other sectors. That's not it. It's a recovery that's required in all the sectors. So not a specialized recession that would suggest some structural reallocation needs to happen. So now turning to some of the good news, there's been noticeable improvement in consumer and investment spending. And these are just data in the top panel for consumer spending and in the bottom panel for investment spending, both of which are showing good positive growth. Consumer spending in the fourth quarter of last year grew a bit over 4% after adjusting for inflation. That's a pretty healthy clip. They did have to decrease the amount of their income that they put into savings to get that increase in consumption, but not dramatically. They're still saving at a little above 5% rate, which is better than it had been in previous years. So some good news, consumers are actually spending some now. That's the top panel. And the bottom panel is just showing you that actually through a good part of this recovery, investment spending has been reasonably healthy. Without that, we would have been in fairly dire straits. And in both of those panels, I'm showing you both the official national income data and some high-frequency indicators that to a certain extent look forward and tell you that things probably will look good in both of those dimensions for the coming quarters. So that's good, some spending going on. Tim will show you this in much more detail. This is a quick snapshot of where the housing market is. The red line is showing you new single-family home sales. And you know, if you read the newspapers, you'd say, well, there was an X percent, 12.5 or something percent from month to month in the rate of single new family home sales in the red line. You can kind of see that on the chart, but the big picture here is that relative to any normal, not just the elevated crazy levels of the mid-2000s, but relative to any normal level, the pace of housing, new construction and new sales is really still quite depressed. So it's improving a little bit by this measure, but it's still at very, very low levels. So another way of putting this is if you said, what would a normal rate of sales or construction be in the U.S. economy, given the demographic characteristics, the age and education distribution of the working population, the level of employment, the level of income that's generated, and the level of interest rates, what would that look like? And the answer is it would look significantly higher than what we see here. So there's still room to go back to not a crazy level of construction, but a sustainable level of construction. That is yet to happen. There are some reasons for that, so I want to comment on those now. One is that it is still the case that while they're not at the absolute peaks, foreclosure rates are still high around the country for many areas. It's also the case that prices are low, and by many measures, they lag somewhat. You know, we have measures through November in some cases, not much later than that. But by those measures, prices are low and in many cases declining in a lot of areas in the country. The fact that prices are low and falling, the fact that unemployment is high, suggests that we're going to continue to see foreclosures going forward. Tim actually has been working with some of our economists in the Boston Fed and around the Federal Reserve System. Some years ago, we started on projects to try to understand the evolution of foreclosures. The key determinants, it turns out, are exactly these two, and it makes perfect sense. The reason that foreclosures happen is not just because someone is unemployed and can't make payments, because in normal circumstances if that happens, perhaps they could refinance, but more commonly they could sell their house. But if they're unemployed or have some other income disruption, and that's coupled with a significant decline in the price of their house such that there's no equity left, then those normal options for dealing with those sorts of income disruptions disappear and foreclosures rise. And you can see that in regions around the country in prior periods where there are regionally concentrated housing upsets, and you certainly see it in the regions around the country today where we're still suffering with a significant housing disruption. So the point there is just with prices low and possibly declining, unemployment still high, we expect to still see some fairly elevated rate of foreclosures. That probably puts downward pressure on prices. It certainly puts more housing on the markets. It's not a sign of a healthy market. And with a fair number of homes on the market, prices low and not necessarily expected to increase, we don't really hear that by and large, it's not a great time to expect a robust housing expansion. Now, honestly, I hope I'm wrong about that. We've had quite a few years of very depressed housing. It's possible that somewhere around the middle of this year, folks will start, we'll see some data that says prices are more convincingly flattening and maybe rising in a few areas. If people believe that to be durable, then they're more likely to put their money into a house if they think its value is going to appreciate. That could start a beneficial housing dynamic, and I hope that happens. Just don't see it quite yet. I will put a plug in briefly for limiting foreclosures. The administration has tried a variety of programs to mitigate the incidence of foreclosures nationwide. I think it's fair to say, if you look at those objectively, they have not been very successful. One simple measure is that they expected to spend at one point up to $75 billion on foreclosure mitigation. They've spent under $1 billion so far on the modifications that are part of the so-called HAMP program. It's not for lack of trying. I think they were trying to do reasonable things. There are other things to do. We've actually been working on that at the Boston Fed in collaboration with some folks down in D.C. Ask me after the talk about, because I have some passion about this too. There are actually low-cost, efficient ways to prevent foreclosures that could be prevented. Some are not preventable. We'll continue to keep pushing on that and see if we make any headway. Okay, so now let me turn to the rest of the world briefly. This is a snapshot of a way of thinking about one of our key financial market threats that's global in nature. And what this is showing you is what various governments pay when they issue their debt to finance their government operations relative to a benchmark economy that's pretty sound and well-trusted like Germany. So obviously the bigger that line is, the larger is the spread for the rate that government pays relative to Germany, the more risky is that government's debt perceived to be, and so they pay a penalty for that. They got to pay higher interest rates to the borrowers. For Greece, 9 percentage points higher than Germany. That's a lot, right? I mean, they got to float some debt. That's not just something that corresponds to the period around between March and May of last year where the crisis was rearing its ugly head. It's remained quite high since then, largely because the underlying problems for Greece remain. To be sure, some government programs have provided them support through roughly this time next year. After that, Greece actually has to do something or they get into some problems with their debt. Spain and Ireland are also on the chart because they also are at some risk. Now, the hope is that those things will be resolved, but I just want to say we don't know exactly what's going to happen in those markets. Should there be a sovereign default or the serious risk of a sovereign default, that really upsets financial markets. The government-issued debts are typically viewed as sort of the risk-free bedrock from which all other financial transactions are gauged, and if the sovereigns are having problems, those sovereigns are on the books of lots of banks, even money market mutual funds in the U.S. and around the world. There will be ripples from that. We don't really need another financial crisis just now. Thank you very much. So, all right. This is one I referred to at the beginning, which is just about this handoff from what has been a publicly sustained to what now needs to be a privately sustained recovery. This is one way of looking at that. And what the black line is showing is what is the growth in income net of the taxes and transfers that the federal government provides to the citizens in the U.S. You can see that in 2008 and 2009, the growth, apart from the taxes and transfers, which are the bars in the chart, there wasn't a lot of income being generated privately. So that was a really important source of support. Now there is some. It was up as high as 4% growth for this sort of privately generated income. It's down to something closer to 2% now. What we really want to know is which way is that line going. Now, I don't think it's going to drop to 0% or below, but the question is whether it really surges to a more robust rate of growth that would be consistent with stronger spending in the economy, stronger employment growth, and then a really privately sustained economy. Still a little question mark about that, but as I said, the most recent data suggests early signs that we're moving in the upward direction, the good direction. But that's where we are right now. We're making that transition. In my view, it was appropriate to have a publicly supported recovery, because without that, you can see how poor the income generation was, declining at really rapid rates. So I think that was appropriate. Now we need to see that transition. And finally, as a central banker, I have to say something about inflation. That's our job. So this is a simple chart. I've just thrown up a bunch of, but I know it's a little spaghetti-like, but it's a bunch of inflation measures that are basically smoothing more or less the data on inflation, because it does tend to bump around. But you know, I don't think you need to be a rocket scientist to figure out what is the recent trend in inflation from this chart. But if you're not sure, I've provided an arrow. you know, it was properly measured, I would say it was in the neighborhood of 2.5% just a couple of years ago. Now, according to our best measures, it's somewhere in the neighborhood of 1% or a little bit below. That's a significant decline. As I said earlier, my sense today is that it's not likely that inflation's moving up at the moment. If we're lucky, it stabilizes at a bit below 1%. If we're less lucky, it continues to slip down. It's not going down dramatically. It does not look like we have some deflationary spiral in the making, but that's a pretty low rate of inflation. I would just add that this is a bit of a geeky technical thing, but it matters. So because of the way these inflation measures are constructed, there's an inherent bias in them, which goes this way. If you see a number on inflation that says about 0.5%, the actual underlying inflation rate is probably about 0. That is, the inflation rate that's measured overstates the actual underlying inflation rate by about 0.5 percentage point. So, according to the statistics released through the end of last year, the core consumer expenditures price index rose by about 0.7 percentage point over the preceding 12 months. But that's really about 0.2 percentage point, right? With the 0.5% bias, we're close to a flat price level. Not the end of the world, but it does complicate monetary policy. It means that as every percentage point that the inflation rate drops, the inflation-adjusted real interest rate is rising, right? So the Fed's stuck at 0. Every decline in inflation means that the real rate of interest, that typically is what most profoundly affects expenditures, that's getting higher. That means it's more contractionary. We don't need that at the moment. So that really does matter. Okay. So to summarize, this is what I think the big monetary policy challenges are today, put in one simple handy-dandy picture that you can show to your friends at a cocktail party to amaze and delight them, and that is that the unemployment rate, which is the red line, and the inflation rate are both pretty far from where we think we'd like them to be. The unemployment rate, as I said, should be down somewhere near 6 or 5% at some point. That would be nice. We've got a ways to go. And the inflation rate, the Fed has not announced an official inflation goal, but you know, we put out these forecasts to tell you where we think inflation's likely to be 5 to 7 years from now. That's kind of saying what our goal is. It's around 2%. We're actually below that right now by a significant amount. So both of those objectives are still far from their desired levels. What cures both of those problems? Strong growth, strong employment growth. That's the reason, I'm going to skip this chart, that's the reason that the Fed has been doing alternative monetary policy issues. We could talk about this for quite a while. I don't have the time and I won't. But this is just to show you what's happened to the Fed's balance sheet. There are actually two different things going on here. So the normal Fed balance sheet, $850 billion. That's still a fair chunk of change. There's some hedge funds that would be happy to manage that amount of money. In the early days, it went up. Those are the yellow, green, orange kind of bars there. Those things were liquidity-focused policies. That is, they were designed to help the functioning of short-term credit markets, short-term borrowing for working capital, for inventory finance, for payroll, all those sorts of things that really matter for real activity, but were severely disrupted in 2007, 8, 9. So those policies were designed to be self-extinguishing. Once they had fixed the problems in the market, they were priced so that nobody would want to use them. And as you can see, those bars all went away somewhere in 2009 or so. But in 2009, while the liquidity problems had gotten a fair amount better, the economy, you may recall, 2 years ago, was in the toilet. And it wasn't clear what the Fed could do because, as I quickly breezed by on the previous chart, we'd already moved the federal funds rate down to 0, and you can't go lower than that. So what did we do? We tried to do some other policies, and this is, of course, under debate today, which would substitute for the normal thing we do, which is lower this short-term interest rate. Instead of doing that, we did what is usually a normal consequence of lowering the federal funds rate. That is, when we lower the funds rate, the hope and prayer is that we affect other market interest rates, longer-term interest rates, because those things are those are the rates that are more closely tied to spending, rates on mortgages, rates on car loans, rates on business loans. Those are the things we care about. With the inability to move the federal funds rate, we then decided to try to operate more directly on rates like that, longer-term interest rates, by purchasing them, raising their price, lowering their yield, and hopefully stimulating the economy in that way. That's what that second bunch of those red bars are about. That's the mortgage-backed securities we purchased, and then towards the end of the chart, you can see the beginning of our most recent program, which is to buy Treasury securities. Again, not that we love Treasuries particularly, but many, many financial transactions are priced off of longer-term Treasury rates. So if we can lower their yields, the hope is we lower yields on other instruments as well that really matter for the economy. So that's what we've been doing. That's the rationale for it. Of course it's debatable. People worry about having a balance sheet that large. We can talk about that in Q&A if you'd like, because I'd love to talk about these things. Okay, so I said that. So what have we learned? I'm going to close now. You might be surprised to hear this, but there were actually hundreds of papers written through about 2006 that talked about the great moderation in the U.S. economy, suggesting big recessions will never happen again. So that's wrong. So they do still happen, and they leave behind a significant imprint on the economy in the form of, especially if there's a financial crisis, but in any event, they leave behind apparently high, persistent unemployment, low and possibly declining inflation. We hope not much further. And these long-term balance sheet challenges, right? It's not the case that the financial and the non-financial sector and the household sector in the United States are all set on their balance sheet. That's not true. I didn't put this chart up, but if you looked at the net worth of households relative to their disposable income, or absolutely, it is still way below where it was at the peak. Now, probably the peak overstated a reasonable valuation of the household's assets. But apart from that, it is at extremely low levels still today. So you know why people are still somewhat cautious in spending. They've seen their life savings and other things and the value of their homes erode significantly. That's also true for non-financial corporate business. So those balance sheets are still there, and I just showed you a picture that said balance sheet challenges coming from the government sector are there abroad. That's lingering. And then the other questions are about how effective both fiscal and monetary policy are at offsetting these fluctuations, because clearly, even though lots of work was done on the fiscal and the monetary side, we still got up to above a 10% unemployment rate. So does that mean we need more powerful tools? Does it mean the tools we have don't work? Those are important questions. So I want to leave it with that, and then I'd be happy to entertain questions when we get to that section. And did I stay roughly in time? Perfect.
Absolutely on time.
Oh, all right. Well, thank you for your attention.
Thank you, Jeff. A man with an internal clock. He was to the minute to where he was supposed to land. Thanks. Our next presenter is Fred Eppinger. Fred is the President, Chief Executive Officer, and Director of the Hanover Insurance Group that includes the Hanover Insurance Company and Citizens Insurance Company of America. The Hanover has over, this might be an old number, I'm sure Fred will correct me, but the Hanover has over 4,100 employees, 1,900 of them here in Massachusetts, where the company has its corporate headquarters just down the street. Since joining the Hanover in 2003, Fred has focused the energy of the organization on becoming a world-class property and casualty insurance company. Before joining the Hanover, Fred was Executive VP of Property and Casualty Field and Service Operations at the Hartford, and prior to that, he was a partner in the Financial Institutions Group at McKinsey & Company, where he focused on critical strategy, operational, and organizational issues for clients in the insurance and the financial services. A true company and community leader, Fred has done an extraordinary job the past 8 years bringing stability, a well-executed strategy, and a vision to one of Worcester's largest employers. Please welcome Fred Eppinger.
Yeah, the best thing I can say is that is dated data. I think we hit 4,700 employees this year, so that's good. Thank you. Yeah, we grew. It's funny. We have been very lucky. We've gone through this turbulent time, and one of the most beneficial things that happened to our company, we were quite fortunate. We were the only major company in America that was upgraded by S&P, Moody's, and Best in 08 and 09, and which allowed us to get through this relatively well. And we grew about $1 billion over the last 3 years, which is, I thank God, every day. I am not an economist, and I sit and Jeff's stuff is so great, but we are business people, and we have a national presence. We're about $3.5 billion worth of business, and our entire business is tied to the economy, because what we measure and what we insure is exposures. So workers' comp is employment growth and sales growth in our liability lines. We insure boats and houses and cars and commercial real estate, et cetera. We also own a lot of interesting assets. We have $1 billion of munis, which is kind of an interesting topic right now, which makes me sleep really well at night. And we also have real estate, and we have corporate as well. So we care a lot about the economy. We've spent a lot of time on it. We think about the trends and the underlying numbers, but again, I am not an economist, and maybe today I'll act like an amateur one, but there is some things that we believe in very deeply that has affected what we do. And so what I want to talk about is how do you survive as a business person in this kind of turbulent time? Because it's not over. I would argue that we got 3 or 4 more years of quite significant turbulence. And you can be depressed by that, or you can look at it as an opportunity, because everybody is a genius in a great economy. But what happens in tough economies is the have and have not separated, and winning businesses actually gain more share in difficult times than in good times. And so the ability to create a business or a city like Worcester to take an advantage comes now. Disruption creates opportunity. And so what I want to talk a little bit about is what we see. There's no question that this has been a significant downturn. Jeff said it well. The monetary policy has softened that blow a little bit. But the question for businesses is pretty simple, right? This unemployment, I'm going to talk about it. I would argue we've never seen anything like this, how sticky the unemployment is. I'm going to talk a little bit about something called underemployment, which to me is even a bigger issue. Because what it does is it takes away buying power. And once buying power is done, it creates a problem, because if you look at the recession, we have excess capacity in most industries. Not every industry, but we have excess capacity. And to get out of that, to really create growth, you got to have earnings power in the system to take care of that. And again, one of the things when you look at it, it really is a broad-based situation that, again, I'm optimistic, things are getting better, but it is different than what we're used to. We would also say that the state problem is in front of us. And so we look around, and a lot of our states are doing very dramatic things to help fix their balance sheets, which have implications. And you saw that chart on employee count where the government employees was the one positive. I'm not sure that's going to be true over the next 2 years. Matter of fact, I'm pretty sure it isn't. And that's going to work its way through the system as well. Now, within all of that, Mass is very interesting. We have a debt issue as a state. And we have all kinds of issues like everybody else, but we have a great diversified economy. We have some really interesting things. You saw education and healthcare up there as strong things, big in this state. So there's some things about us that are very interesting, but I would argue that even more interesting is Central Mass. Central Mass has some very interesting structural advantages that this kind of turmoil makes us a little bit in the catbird seat if we address it properly, because we are lower cost than Boston. One of the greatest things about Worcester is that Boston is on an ocean. And what I mean by that is Boston can't grow east. It only can go west. And so our advantages are significant because we have less cost, more convenience, and have a lot of opportunities to have more growth here, frankly, than in Boston. So again, our view is that tough, but an interesting opportunity. Now, we also could look at the statistics. We had a recession, growth bounced back. The problem is what Jeff said. It's unemployment. And again, I got a chance to work at McKinsey for 16 years. I worked in every part of the country and every part of the world. And what's fascinating about this versus anything I've ever seen before is it's shared pain. The Mid-Atlantic isn't saved. The South isn't saved. This isn't about the Rust Belt. Unemployment is broad-based. These are the worst 25 states. There's no pattern to those states. Those are just not the old industrial states. This is broad. And the other thing, I totally echo what Jeff said. People say it's about construction. No, it isn't. It is a broad-based thing when you look at these numbers. And if you look at this underemployment, which I think is just as big as unemployment, you know, typically the underemployment, people that are kind of in jobs that are significantly less than what they were before, there's about a 4-point gap. That gap is now 7. So not only do you have unemployment, you have underemployment of a lot of people. We're at about 17%. It's probably different now because I don't watch this every day. But you know, when you insure things like boats, you notice, right? That just dropped off the cliff. You know, we have $1 billion in Michigan almost. 40% of all people in Michigan are on some kind of public assistance. That changes the buying patterns of people. And so what you see is this underemployment is a game changer in a lot of ways. Now, this is the unemployment from all the recessions, you know, coming out of all the recessions in the last few decades. And the red line is the employment jump back this time. Much slower. And again, I don't know all the science of it. I don't have a PhD. But all I know is that it's an issue. And for our business, it's an issue in a bunch of ways, both exposure, fraud, overutilization by contractors that are out of work. I mean, it just comes up in a lot of different ways because of this. And again, it's different. It's different. Usually other recessions, it bounces back a little bit, okay? This one, it's staying. It's a new reality to some extent, where we are, what we have to do, how we have to manage our businesses. And if you look at a couple of things that I look at, one of the things that people have done is they fixed their own balance sheet a little bit. Maybe not all the way, but if you look at the financial, people have gotten out of debt. They've reduced their credit cards. They've reduced their cost of home ownership, right? Not probably as much as they could, but it is dramatic. I wish the government would be as good at this. But people adjust. So what you see, and these are their financial obligations, they've dropped. People are getting their balance sheets in order. And the houses that are being built are smaller square footage now because of this, right? So people adjust. You're seeing it in all kinds of things. New cars, boats, house sizes. People are being thoughtful. More rental versus ownership, right? You're seeing it. So again, there's things about this, if you think that this is going to last a while, that people's patterns are going to be a little bit different. They're going to be more thoughtful about the value of things they acquire. Now, the other thing is people were using their house as an ATM. So what we see is, if you look at people that took home equity out and spent it, it really enhanced their ability to buy stuff. Well, that's dried up, both because of the value of the homes, and people have stopped doing it because they're getting their balance sheet in order. But it really was like an ATM there for a while. So what you saw is in a lot of economies, you kept seeing the purchasing going up faster than the income, and you kind of say, well, why is that? Well, part of it is the values that people were extracting from their assets. And that has stopped, right? So again, for us in business, it's noticeable, right? You can see those patterns across the business. And again, if you look at the other side of the equation, and again, I buy inflation is under control, but one of the fundamental things that we worry about, and I worry about personally, is the percentage of your disposable income that is now health care. Because it's now over 21%. And it's not discretionary. And so that is eating in, again, to the disposable income of people. And in Massachusetts, this is a big deal because we're the most expensive place, particularly east of 128. And so again, that's different, right? And so the question is, are they going to be able to go out to dinner and buy these houses and buy these cars and generate? So again, this is structurally different. Not that we can't solve it, because we can. And there's lots of studies that say cost of care has nothing to do with quality of care, and there's ways to get at this, and we're going to get at this, but it is real. So again, the purchasing power has changed during the structure, and now we see it, right? And the question is, how long before it changes? And so when you look at disposable household income, we believe it's going to be flat. So when we do our plans and we think about things, we don't think that it's going to be easy. We think that this is going to be a pie that's not going to grow a heck of a lot, even if unemployment gets a little bit better. And even if you see federal tax rates go down, our argument is that state and local taxes will probably go up as an offset. So again, not saying you can't win, not saying it's a terrible thing per se, but it says that businesses and people are going to watch their dollars. They're going to think about where they spend them. They're going to spend them in a more careful way. Then when you add that employee, you're going to think about adding that employee because the room is not as much room as there was before. The issue, again, in my view, what's exciting is that not everybody will adjust to this very well. So it creates lots of opportunities for certain geographies. It creates lots of opportunities for businesses if they react to this new reality in an interesting way. And so when we look at Massachusetts, I like a lot of the opportunities we have, particularly in central Massachusetts. There's no question that our mix of business, if you go to a place like Michigan, or you look at some of the other Midwest, their distribution of industries is not nearly as great. So the disruption these disruptions, it's hard to react to. We have a lot broader base to work with. We also have the educated workforce. We actually have a location advantage for a lot of businesses. You know, I have a lot of friends that run companies that ran and put their call centers in Iowa. Well, getting young professionals to go to Iowa is not always the easiest thing in the whole world. And so the reality is that this is an attractive place in a lot of ways. But we have some problems. We have high-cost healthcare, we have high-cost housing. And that's particularly, again, true in Boston, which is why I am so bullish on Central Mass, and why, by the way, you've seen all this wealth move west, because the cost of living here is better, and it's not just housing. It is also healthcare. There's a lot of things that's better. Public education, a lot of things when you look at typical households. Central Mass is much better. So if you look at Mass as attractive in general, if you want to be around here, and you want an urban setting for young professionals and good business people, there's not a lot of alternatives that are as attractive as Central Mass. And so my view is within all of this, that's why, and it's because I'm sure when you're listening to this, you're saying, wow, he doesn't seem very positive. Why the heck was he dumb enough to invest $85 million in Worcester? Because I believe in the outlook of the city. We didn't do this for charitable reasons. This whole city square thing to me is because this is an opportunity to make a city of Worcester, the finest small city in the country. And again, I think that there's a lot of trends here that would allow us to do some very interesting things. But we got to understand, in my view, some of the new realities as business people. And again, you guys are smarter than I am, but when I think about it from our perspective in our business, there are some new realities in business that you just got to get in your head as you think about competing. And the first one is this notion of there's no such thing as the rising tide is going to lift all boats anymore, or at least for the next 5 years. You know, the bounce back aren't going to protect you. There's not going to be excess capital from the public sector to kind of take care of all the folks that aren't very good. In my view, we have scarce resource. And when you have scarce resource, making choices is really important. You know, strategy isn't what you do. Strategy is what you don't do. And so when scarce resources come, it's all about making choices. So those companies and firms that are clear and make the right choices will win. You will see significant share shift in many, many industries, and you're seeing it already, as people that are much more clear on what they don't do. The second thing we're going to see is this notion of limited capital access. What's fascinating to me is we are at the classic point in a cycle where if you don't need money, you can get it. If you need money, you're dead. We have $500 million of excess capital sitting on our holding company. I can get debt anytime I want. But if you don't have that, it's a heck of a lot more expensive, right? That Greece chart is, you know, just another example of that. And so this notion of a quick buck, which gets a lot of real estate folks in trouble and a lot of businesses in trouble. The notion of taking on too much debt when you do an acquisition, or taking on too much debt when you do an expansion, or expanding too quickly is a real risk right now, because getting access to naive capacity or capital is limited today. And so my view is that the good old-fashioned notion of having a strong balance sheet and growing within your means and being focused on the strength of your balance sheet and building for the long haul is who's going to win, right? And again, you just see it industry and industry and industry. We're in the insurance industry. We have a lot of industry. We have a lot of independent agents. Good agencies, too much debt, they're not going to be around. You can see it. And so again, I think this plays out time and time again, because the easy money, it's not clear that's going to be around for a while. Third thing, in almost every sector we see too many suppliers and enough customers. Not true everywhere, not true in every geography. But if you think about the excess capacity in so many industries, right, from cars, which is working out of the system, to housing, to, again, it's across the board. You see all these industries that overbuilt, right? Maybe because of outsized spending, because of consumers, whatever. What that drives often is consolidation. So what you're seeing in so many industries is consolidation and this whipping at getting out of this excess capacity. So to me, as a company, what do you do in that situation? You got to build customer loyalty. You got to build, it's always easier to get more from current customers than to get new ones. You got to lock down your clients. You got to lock down your customers. You got to lock down your franchise. And if you have that strong balance sheet, the ability to actually win in that environment goes up. But again, this isn't something, and again, Jeff was really good on the data, because sometimes, I just make all this stuff up. So it was nice to actually see. But this notion that it's going to take a little bit longer that's what we see too. It's just, it's not going to jump, right? You're not going to just get rid of all this excess capacity. And so this will lead to some business decisions that will occur in most industries. Now, if you look at the consumer, and again, we do more with business to business, obviously, through independent agents. But in this world, when you have less money, that means you're tougher on everything you buy. You want more consistency. You want more for your dollar. And those companies that can consistently deliver value, not price necessarily, but value, are going to win. And it's clear because people are choosing. And it's why I like the private sector and healthcare more than public, because we were starting to get, through deductibles and copays, people making choices, thinking about it, where they go, taking control of their own situation, because that's what drives costs down, is a consumer that's making choices that's requiring you to be more consistent and more effective. And what I see in most sectors is consumers are getting more educated on their purchases because they have less to play around with. And so that shakes out the haves and have-nots. And it doesn't always lead to the low-cost provider. People laugh at me. They say, well, does that mean Geico wins in our business? No. Because if you have a home or an umbrella, you need an advisor to help you protect your assets together. They're actually not very good at that. It's value. It's consistency. It's delivering something of value. So when I think about the economy and the optimism that I have, we will get out of this, right? Where our education system, the quality of our people, we will get out of this. The issue is that there's no silver bullet that we see in the next 3 or 4 years. I just see that it's a gradual getting people back to work. But in that period, there will be excess capacity. And as a business person, I think we can do well. And as a person in Central Mass, I think we can do very well if we rely on our advantages of cost and convenience, and we enhance kind of our infrastructure, our transportation, our ability to attack this, so that we become the alternative to some of the higher cost options. And I would say in most industries that's true, because of where we are situated and because of the way historically Central Mass is set up. So again, I thank you very much for this opportunity. These folks are so much closer to the day-to-day economy of Massachusetts. But as I said, as business people that have almost 5,000 families we worry about, we think about this every day, and we believe that there's a lot of opportunities to grow and win. It's just a very different environment than it's been. Thank you very much.
Thank you, Fred. That was fantastic. I think Jeff, in his role as the Wizard of Oz, should be pinning on Fred an honorary economist little heart or tag right now. I think you earned it. That was terrific. Our next presenter is Tim Warren. Tim is the Chief Executive Officer of the Warren Group, a publishing and information services company that is now in its 4th generation of family ownership and traces its roots back to 1872. The Warren Group has been collecting and publishing public records throughout its history and is best known in Massachusetts for its real estate paper, Banker and Tradesman. The Warren Group's extensive database of real estate sales and ownership records is used by real estate professionals throughout Massachusetts, Connecticut, and Rhode Island. With his company's long recognized leadership in the real estate arena, the Warren Group is a regular contributor to the Boston Globe, WBZ Radio, Boston Herald, NECN, among other media. Tim joined the Warren Group in 1973 and became its president in 1988 and its CEO in 2004. If you wonder what your home is worth now or might be worth 5 or 10 years from now, please meet the man from behind the curtain, a prognosticator with as good a crystal ball as anyone around. Please welcome Tim Warren.
Hey, there I am. Well, thank you for having me, and thank you for the introduction, Peter. Do we have any realtors in the room? Okay, I see one. I want everybody at his table, before you go home, make sure to give him a hug, because this weather is just killing the realtors. And, we have a tough real estate market, but the weather is certainly not helping. So give that man a hug. I just want to go over the topics that I have planned for today. The current state of the market, talk a little bit about your area, Worcester County specifically, have some slides on foreclosures, and then I'll give you my forecast. Just in case Peter gives me the hook before I get to my forecast, let me just say that I think we're rattling around at the bottom of the market right now and have been for a year, and I think we'll continue to be at the bottom for another 6 months or maybe a year. Okay, now I've got a lot of slides, so I'm going to try to run through them and maybe skip a few to stay on our schedule here. So in terms of the current state of the market, we've been in a decline. I really trace it back to 2005. That's when the number of home sales, single-family home sales in Massachusetts started to decline. In 2005, we had that first sign where the market started to slow down. Sales for the whole year were down about 6.3%. 2006 was a really terrible year where they slowed by another 16.2%. From 2005, and it kept falling in 2007, 2008. In 2009, we actually had a little bit of a boost. That was thanks to government intervention and the first tax credit that expired, I think, in November of 2009. And then last year was really a tale of really two markets where we had a very good first half of the year, and then things started to slow in terms of the number of sales in the second half of the year. We finished down a little bit less than 1%. And now here is the median prices. Median prices tend to lag the curve on the number of home sales volume. So prices were still rising 5.2%. In fact, in 2005, slowed a bit to rising just 2.8% in 2006. And then 2007, they were flat. In 2008, they were down almost 12%. 2009, they were up almost 7%. I mean, they were down almost 7%. Last year, because of the starting to improve sales volume in 2009, we actually had a gain in median prices of 3.5%. This is data on condominium sales. A similar pattern. I'll just say that condominiums entered the decline a little bit later than single-family homes, but they've been harder hit than single-family homes. So I'm going to skip through the condominiums here. This is a long history of 1987 until the present, just in terms of sales volume. You can see that we had a similar situation back starting in the early 1990s. In 1987, home sales started to fall, and they fell all the way down to a point of about 36,000 in 1990. And then they started to improve. You can see we had a couple of peaks, and then in 2001, before the internet bubble burst, we had home sales of almost 66,000. And then you can see a recent decline down to about 40,000 in 2009. This is a similar chart for median prices. You can see that they were climbing until 1989, and then they fell. Then we had a long, steady, wonderful growth. Anybody that owned a home did very well during the period from the mid-90s to 2005. Now, one thing I should point out is that the median prices in the 1990s, it took about 5 years after the median prices hit their bottom. It took about 5 years for them to get back to their previous high. And I think that is a pattern that we shouldn't expect anything faster than that in this current market. Once again, this is a curve for condo sales and the median prices for condo sales. I'm going to skip over those. This is just a summary of just what's happened recently with the sales volume. In 2009, it was up about 3%, and then last year it was down 0.7%. And this is two-family homes and three-family homes. Two families were up about 6.2% in 2009, then they fell almost 4% last year, number of homes sold. Three families had a similar pattern, 6.6% gain in 2009, and then a fall of about 4% in 2010. Median prices, single families were down almost 7% in 2009, but then they had a modest gain of 3.5% in 2010. Two and three family homes fell about 10% in each case in 2009, and then 10 and 13% gains in 2010. I think the multifamily homes have regained their value and have become popular probably with some investors in recent times. Now let's talk a little bit about your home territory here of Worcester County. As you all probably know, it's the second largest county in Massachusetts. Population is about 784,000, and its population has actually made a gain since since the year of 2000 of about 4%. Now this slide I put in for Fred to show what a good deal Worcester is. The top line is Middlesex County, just to your east, which is probably the most affluent county in the state. And this is the number of home sales in Worcester County. And in Worcester County is the red line at the bottom, and Middlesex County is the top line. So more sales in Middlesex County, obviously, because it's larger. The one thing I would note that around 2002, Middlesex County seems to have suffered a steeper decline than Worcester did, and I think that's probably the effects of the high-tech, the internet bubble that burst that slowed down sales there. This is the median prices since of the two counties. Worcester once again at the bottom. And you can see that it's certainly more affordable than Middlesex County. Similar curves in both cases. Now we had a look at the different towns and cities within Worcester County, and we've now ranked them by their median price. Southborough is the most expensive town in the county, with a median price in 2010 of $540,000. Then comes Harvard, Bolton, Westboro, Shrewsbury, Upton, Northborough, Grafton, Berlin, and Sutton are the top 10 most expensive communities in Worcester County. Worcester, the city itself, still very affordable at $170,000 for a single-family home. Here are the winners. If we define a winner by how little the home values fell from 2005 to 2010, here are the ones that performed the best. Shrewsbury, home median price fell by just 4%, followed by Southborough, Sutton, Holden, and Westboro fell by about 14%. So all of the other communities in Worcester, we eliminated the very small towns, fell by more than 14% from the peak in 2005 to 2010. And then what list would be complete without a list of losers? These are the ones that suffered the most, and you'll see that they're mostly communities with lower median prices. Athol fell by almost 45%, down to $99,000 for a single family in Athol. Hopedale, Fitchburg, Southbridge, and Gardner were the others. I think these are probably considered to be the blue-collar communities of Worcester County. Now I'll talk for a little bit about foreclosures. This is a chart of the petitions to foreclose. Now, I'm not sure if you're all familiar with these, but they are the first stage of the foreclosure process. A lender goes to land court and puts in a piece of paper that is notifying the court of its intention to foreclose. And you can see that they peaked back in, I think, about May of 2008. That was sort of an artificial peak because I think lenders were hurrying to get in their foreclosure paperwork before a moratorium was put into place. And so you can see that steep decline back there in 2008 was because of a state mandate for a moratorium on foreclosures. And then you can see after the moratorium ended that they began a long and steady increase with a few ups and downs, peaking last summer at about almost 3,000. And then remarkably enough, we've had a real slowdown since then. The December number, I think, is 733 from a summer high of almost 3,000. And there are a number of reasons for this. I think basically pressure to slow down foreclosures. You remember all of the concern about what people have, whether foreclosures are being handled properly, legally, had an impact on the number of filings. Now here are the petitions to foreclose for Worcester County. You can see that they have a similar pattern recently, peaking in the summer at almost 500 and then falling to about 323 as the December number. Whoops, we've already seen that one. Confusing myself. So just to recap the actual percentage of change, for the petitions to foreclose, the first stage of the process, they were up 28% in 2009, and then they actually fell in 2010, mostly based on the fall and early winter declines. So overall for the year, they were down about 14%. The deeds, the actual deeds that were recorded for foreclosures, those actually fell in 2009 and grew by 32% in 2010. So they're sort of going in a different direction from the petitions to foreclose. I think a lot of that has to do with timing issues and the very slow process that lenders are using to clear up the titles on all of those and get them into the Registry of Deeds. So this is Worcester County once again, and these are the number of foreclosures, the petitions to foreclose last year. Worcester, being the largest community in the county, also had the largest number of foreclosures. 960 were initiated last year. Fitchburg, Leominster, Gardner, and Milford were all in the top 5. And then we had a look at the communities throughout the state, and I'm sorry to say that Worcester had more than any other community last year with their 960. Springfield was second with 945. Brockton, Lynn, and Dorchester rounded out the top 5. Once again, I think you'll notice that all of these communities are the blue-collar communities that have been hit so hard by this economic crisis. Now we're on to my forecast, if I still have another minute, Peter. We had a look at some of the national predictors of the economy. Moody's Economy.com predicted that the median home price, this is nationally, will fall from 172,000 to 162,000. This is the fourth quarter of last year to the fourth quarter of this year. That's a decline of about 6%, 5.8%. That may be true nationally. I don't think that's going to happen in New England. The National Association of Realtors, we have one of their members here, ever optimistic. They say that median prices are going to actually increase probably by about 0.6%. And then we had a look at the more local data. From the Massachusetts Association of Realtors, we find that the pending sales decreased by 7.3% in January. This is probably mostly weather-related. It just means that homes that went under contract, there weren't as many in January of this year going under contract as there were in January of last year. And we also found that the inventory of single-family homes, the homes are actually available for sale. Those grew in December compared with the prior December. They're actually up by about 11%. So Home shopping should be good, lots of homes and low prices, so get out and invest in your community. The Case-Shiller Home Price Index, which uses our data but measures home values as opposed to the median prices that we actually use, they say that the Boston real estate market in the 20 markets that they analyze was actually the third best in terms of one-year change in median price. So I think the message here is that Boston is doing a whole lot better than other parts of the country, the ones that are really hard hit. Michigan and Nevada, Arizona, Florida are suffering from severe declines in home value. And if you, on a longer term basis, they also, their data shows that Boston is the 5th best market out of the 20 that they follow in terms of holding or actually increasing its home values since the year 2000. So for sales volume, what I'm going to say is that the volume is really going to be challenged by two primary things. The winter weather is going to really affect the closings that we find in March and April. People are so busy shoveling, they're not out looking for homes, and the homes they might want to look at probably haven't been shoveled. So it's tough. And the other thing that's holding us back on the sales volume is when we compare it with the prior year. You remember that last year was very strong in the first half because of the second version of the home buyer's tax credit. And so we had high volume last year. It's going to make it a high bar for us to measure up to this year. So I'm really looking for no real substantial improvement until the third and fourth quarters of this year. For the whole year, I think its sales volume is going to be essentially flat, and that'll be pretty much the third year in a row we've been not having a significant increase or decrease in sales volume. So I'll say that we should finish up the year with about 41,000 home sales, and that compares with about 65,000 in the year 2004. So nowhere near the kind of robust market that we saw at the peak of the market. In terms of median price, I should point out that that last year in 2010, median prices fell just 1 month out of the whole year, and that was the month of December. And the decline in December was about 6%, and I really attribute that to the low sales volume that we had during the last 6 months of last year, as the tax credit expired and people were no longer had it available. We just didn't see very many homes sell, and eventually that showed up in the median price. Now, the low sales volume that I am predicting for 2011 in the first half of the year, I think is going to put a further downward pressure on prices. The second half, I think, could show some improvement. So I'm looking for a median price of about $300,000, which is up from about $295,000 in 2010. So that's my prediction for the whole year of 2011. Remember that for the country, we were talking about $172,000 median price. So Massachusetts is clearly more expensive, less competitive in terms of home purchasing power. Now, for foreclosures, they declined in 2010. We've already seen that slide. But I don't think the reasons were really improving conditions, but a deliberate slowdown. And I think that foreclosures are likely to increase in 2011 due to catch up on existing defaults, mortgage delinquency rates that are still high, and continued high unemployment. So I'm looking for petitions to be somewhere around 24,000 in 2010. And I got to the end just as Peter was coming to drag me off the stage.
Thank you, Tim. Fantastic. Thank you very much. I'm going to jump right into the questions. I'm going to start with, there are some questions that were in common on the cards that came forward, so I'm going to start with the ones that were asked at least twice. And a couple of these are ones where everybody can throw in their 2 cents. I'd like to get through at least 3 or 4 questions. So the first one is, how will the potential privatization of Freddie Mac and Fannie Mae affect mortgage rates and home ownership opportunities in the future, and also phrased as the announcements of reforms of those two organizations are imminent, what are the optimal long-term reforms? What are the best optimal long-term reforms for these institutions? And anybody can jump in first. You want to start, Jeff?
Oh, sure. So, you know, there's supposed to be an announcement today about what the plan is for these guys, so it'd be nice to see what that is before I shoot my mouth off too much. But what I would say is, it was long the case that Fannie and Freddie, one, although they were not explicitly government guaranteed, benefited from the impression that they were government guaranteed so that they had a lower cost of funds than they would have otherwise. That's probably going to change. No matter what happens, that implicit guarantee, they'll be privatized, there'll be clear lines of delineation. So if their cost of funds goes up, then for some borrowers, it is likely the case that the cost of mortgage financing goes up somewhat. How much is a question of debate. I saw estimates recently that suggested it would be in the neighborhood of tenths of a percentage point. Okay, so we can live with that. It's not that mortgage rates go from 5 to 8%. They go from 5 to 5.3 or 5.4. Is that right? I don't know. It depends on the market reaction. It also depends on the specifics of the reform. In terms of what are the optimal reforms, boy, that's a tough question. Optimal, how about reasonable? While it's not politically popular to say, it is the case that the U.S. has decided over the last 5 decades to provide really significant subsidies to home ownership. That's been great for the real estate business. It's not clear that that is the first best use of all of our tax resources, right? I mean, we give tremendous tax breaks for home ownership. I think home ownership is a great thing, but it's certainly worth a healthy discussion about exactly what the degree of home ownership subsidy should look like in the U.S. We have other pressing problems. We need to take care of health care expenses. We need to take care of retirement, Social Security, and so on. So I think it's unlikely that there'd be a sea change in the amount of support, but you could imagine some change, probably gradual, in the degree to which we subsidize home ownership. Again, I'm for it. I own a home. I think it's a good thing. But compare us to many other countries, we go way out of our way to subsidize that. So there's, I think, a healthy discussion that's beginning today about what is the right level there, and it's possible that some of that will remove. But if it does, it would be gradual and not so dramatic that people's house values plummet or the cost of housing goes up really, the financing cost of housing goes up dramatically. Anybody else want to tackle that?
Well, I would say that I pretty much agree with Jeff's views. You know, I think probably what we're going to see is some kind of government support for home ownership. The rates of home ownership have climbed in the last 20 years. But I think that government's involvement and Fannie and Freddie's activities, you know, extended far beyond what they needed to in order to support a healthy real estate market, and I think we'll probably get it right the next time.
Okay. All right, let me just jump to the next question. If several states default on their bonds or pension obligations, what effect will that have on the economy? Also stated as, please comment on the state of the municipal bond market in light of growing concerns about cities and states' long-term pensions, healthcare liabilities, et cetera. Do you expect municipal bond yields to remain high and prices low for some time? Fred, do you want to start with that one?
Yeah. It's all going to be fine. I keep telling my shareholders that. I actually think what you're going to see in the next 6 months is going to trigger a lot of interesting insight. The whole issue for me is how much they go after the expense bases of the state. I mean, it really is interesting as you look at almost every new governor, their number one priority is about their economics and balancing their budget. And things they've never addressed before, they're willing to address. And I think there's some low-hanging fruit. I think we've undermanaged Medicaid across the country, and the quality is suffering because of that. And so you can get higher quality and better managed care and reduce the cost. We've not really wrestled with a lot of the other areas of expense that the state has backed into. And I think if we see the right actions, I think it's going to actually stabilize. Because I think people are overreacting right now to Illinois and to California and a couple of others. And if there is some significant actions, I think people will stable. The notion of bankruptcy, while is it, you know, at some level is attractive because people, oh, well, then we can go after the pension. You know, the reality is just like the governments of Europe, it is a big part of the financial stability of this country is the municipal bonds. I mean, the implications of not knowing if that's stable is, to me, not something we want to deal with. And by the way, it's better for all of us if they just get their economic houses in order than not. So I'm actually quite bullish. I mean, you know, when Jerry Brown talks about expense reductions, oh my God, I was like, I fell off my chair, right? So the reality has hit the governor mansions directly. And I'm very excited. I mean, I saw for the first time a PowerPoint slide by a governor. It was fabulous. Rick Snyder in Michigan, who went and looked at the income rates of people and then the costs of state government and salaries within state government, and just showed that and said, guys, you can't do that, right? All of a sudden, this transparency, and he doesn't, you know, people are going to stop treating the populists like they're stupid, and they're going to put the facts out there, and the folks are going to start making real decisions. So I'm actually, you know, the last 2 months have been really encouraging to me, the dialogue, the discussion. So I'm actually bullish on this, but it's a big deal. This is not something that's easy, right? I mean, these folks, we have to stabilize and balance a number of significant budgets across this country to make this work, particularly the worst 7 states, right, that really have the biggest issues.
Jeff, can you comment on what Jerry Brown is thinking or anything further on the?
You know, I'm sad to see that Linda Ronstadt has less of an influence now on the state of California than she used to, and the Stone Ponies also, her former band. Well, I hope what my neighbor says is about right. I don't have a forecast for municipal bond yields, and I probably wouldn't announce it if I did. I would say, you know, California and Illinois account for a significant fraction of state GDP in the United States, so they have really large challenges. It is good to see that even a guy as I guess, liberal as Jerry Brown is taking that seriously. They have a lot of work to do. You know, will that mean that the municipal bond market will fall apart? I think he's right that there's been some overreaction to the likely evolution of state budgets. But there's a lot, you know, that's a big number out there in California. They have a lot of work to do. That's going to take some upheaval. So it's good that they're getting started. It's going to take a little time. You know, there's still some fragility, I think, in that in the market, in the state and local picture generally for the next year or two.
Okay, let me jump back to another real estate-related question, and I'm sure Tim will jump in on this as well. Jeff fed us the please ask me this question while presenting, and 2 people did. Please elaborate on your ideas about managing foreclosures that you mentioned in your talk, and also please share your views of options in lieu of foreclosure.
So my views are that they're simple. By and large, the government programs to date have focused on making permanent modifications to mortgages, when, in my view, the primary cause of mortgage difficulties is temporary disruptions in income coupled with declined prices that put people in the situation of 0 or negative equity. So providing permanent modifications for people who generally need temporary assistance is a bit of a mismatch. The good news there is that permanent modifications are expensive, although they haven't been able to make most of them stick so far, so it's not costing too much. But fundamentally, they're expensive. The temporary modifications, less so. The ideas that we've been talking about are essentially forms of forbearance. For a period of unemployment, it's relatively easy, not trivial, but relatively easy to establish that a person is suffering a spell of unemployment, to offer some support in the form of forbearance, essentially, for the person who is unemployed until they get back on their feet. That does, for relatively low cost, that keeps the mortgage paying. The mortgage holder is happy, the person stays in their home, and when they get a job back, which generally people do, things revert to normal. The reason I say it's low cost is because what you can do simply is pay the interest cost of borrowing, the servicer borrowing, for example, the mortgage payments over the course of a year. That's a relatively small number. The average monthly payment in the U.S. is around $1,450. The interest cost on that over the course of a year is hundreds of dollars, not millions. So even if you helped 3 or 4 million people, that would be in the very low $3 billion of cost. Relative to what has been spent otherwise, that's a low cost, it's a relatively efficient way to do things, And because we have data that suggests this proximate cause is income disruptions, it's not primarily that people are in permanently unaffordable houses. It's that they've had income disruptions. That's the problem. Finally, to the extent that people are in permanently unaffordable houses, so in my view, I'm a pretty, frankly, liberal guy, but I don't think it's the best use of public money to subsidize people who are in permanently unaffordable houses. That's a bad decision. It's unfortunate. I'm not saying there's no pain involved, but it's not maybe the best use of public money to keep people in what are really permanently unaffordable houses. That's my stump speech. So vote for me in November.
All right. Tim, you've got a good perspective, certainly, on the foreclosure trends. Any
Well,
additional thoughts?
I guess I would say two things. I mean, one is that I think it's in almost everyone's interest to try to prevent foreclosures and keep people in their homes. They're so disruptive to neighborhoods and to people's well-being that we really owe it to ourselves to do all that we can. And I guess the second thought is that I have heard some plans like what Jeff is talking about, but also some ways of trading the assistance that you get for some shared equity and any appreciation that should happen in the home later. And so some of the repayment comes if real estate prices and values should rebound when the home is sold. Then the entity providing the assistance would get a share of that increase.
Okay, and here's another one that came up twice. Will the economic recovery be impacted by the sale of the New York Stock Exchange to a German company, outsourcing of jobs overseas, and the underground economy with people working off the books onto the table? And the second question related to that was, what does the proposed sale of the stock exchange say about the preeminence of the dollar? And interesting that you, I think this is Jeff, compared the sovereign markets to Germany and not to the dollar. So is this an emotional blip, or is this something significant, the Bourse?
So I think to a first-order approximation, it's an emotional blip. It is hard to, I sort of saw this headline. I said, wow, wait, the New York Stock Exchange is going to be owned by the German Bourse? I mean, that's weird. I grew up for years watching the New York Stock Exchange flash its tickers by and all that. How much difference that makes to employment in the United States, I think, is trivial, right? Who happens to own the exchange on which these stocks trade, to a first, second, and actually third-order approximation doesn't really matter. It's an emotional thing. What will it do to the dollar? Not much. The impact on the dollar in the short run has to do with how the mass of financial flows are going in or out of this country. That will have to do with the relative attractiveness of the assets in this country, not who owns the exchange on which they actually trade. That's the primary determinant in the short run. And in the long run, of course, it has to do with trade flows. And that has essentially nothing to do with who owns the New York Stock Exchange. So the good news is, I was also sort of upset to see that maybe the New York Stock Exchange, which is kind of a pillar of U.S. capitalism, might be owned elsewhere. I don't think that's going to have any noticeable effect on the U.S. economy or on the value of the dollar.
Okay.
Anybody want to debate that?
Anybody else want to jump in on that one? I've got another question ready. Fred, you referred to people, especially in Michigan and the Midwest, sort of fixing their balance sheets, which is reducing debt, whether it's credit cards and so forth. And Jeff, you also talked about the savings rate in the country. What is the right balance? I mean, we've heard, we're a consumer spending-driven economy. Savings is good, isn't it? And yet we see that some savings is bad. So what is the right balance between sort of fixing balance sheets, the savings? What should be the savings and spending?
That's a PhD question.
Yeah, sure. So you've got like a half a PhD already, I think. You got the P part, yeah. So, this is a little bit like the prayer of St. Augustine, who said, Lord, make me chaste, but not today. So make me a saver, but not today. So, and what I mean by that is just that, for sure, in the long run, savings is good for the U.S. economy because it provides a flow of funds that are used for investment, which is the bedrock of growth in the economy. The problem is, with a fixed amount of income, the more people save, the less they're spending, and the fewer jobs that creates. So I think, the long-run prognosis for the economy will look better if we do some more flow savings. And the reason I use the word flow savings is what that means is when people get a paycheck, they actually take some fraction of it and put it in the bank. That is in contrast to the savings that was done in a lot of the 2000s, the naughty Audis decade, where people saved by watching the value of their houses and stocks go up, capital gains. That's nice if it happens, but you can't count on that. A more sustainable, durable form of saving is in flow savings. You put some of your money aside for the things you're going to need it for later. The right balance is very hard to say. What we do know is that from work done at Boston College and other places, Alicia Manel, the former person who had my job before I did at the Boston Fed, person who hired me at the Boston Fed, has done work that shows that a lot of people are grossly unprepared for retirement. That's not good, right? So in some sense, we do need to change the way in which people prepare for their savings, putting more money aside gradually over a long period of time, instead of hoping that the value of their home is going to skyrocket and they can cash out on that. So there is a balance there to be struck. I don't hope for a tremendously high savings rate right now for the reasons I just articulated. I don't hope to see the U.S. economy decline, but I do think as a secular matter over the course of decades that people learn from this episode that savings is a good thing to do. Preparing for your future prudently is a reasonable thing to do. As an aside, I would say, you know, not just as an economist, but as a citizen, I think that the composition of consumer spending could change in ways that would be beneficial. And that is, I actually think spending 20% of our total income on healthcare is a fine thing if it's spent efficiently, and that's what we choose to do. It is actually expensive to deliver really good healthcare to citizens in the economy. By and large, citizens want that. If they have some choice over it, if the markets are reasonably efficient and people get to choose what kind of healthcare they get, I could see the composition of spending shifting towards healthcare and education, very important, and away from big screen TVs, right? I mean, I have a big screen TV in my house. I don't need 6 of them. I think we overspend on luxury consumer durables at the expense of other items that are really give more enduring value to people, extend the length of life and so on. That's more of a personal preference statement than an economic statement. I don't want to see consumption decline, but I could see changing the composition over time and things that have more lasting value. There are people who manufacture big screen TVs that'll be after me for this, I'm sure, but that's as an example of the kind of consumption spending that we do ridiculous amounts of in this country compared to other countries. We could keep a very high standard of living, high level of spending, change the composition. That might be good.
So here's my suggestion. When we have Jeff back next year, let's get one of those old sort of projectors where Jeff can have that little plastic film and draw on top of it, and he'll just make
Right.
his slides up as we go.
Absolutely.
Fantastic. Fred, you talked about exposures in that balance sheet issue. Any further comments on?
I think that's right. I mean, the issue, it's always a good crisis is you don't want to waste it, you know? I mean, to me, too many people don't save, do live paycheck to paycheck, not just the folks that have to. There was a lot of folks that made that choice. That's why I showed that chart on using your home equity as an ATM. Where those monies went were not permanent value. It was discretionary spending that doesn't help you. And one of my big fears is that as pensions have gone away, and has people, you look at the 401ks, and up until this crisis, how little people used and saved. It's scary because as those people age, you could have a real problem with elderly poverty that you just don't want. I mean, and so to me, we haven't really come to grips with that because this generation shifted from pensions to non. And so we watch this a lot, and I would argue that hopefully people remember this because what I showed is they're starting to see, you're seeing the change, right? And that's not a bad change. So yes, we need the consumer spending, but I would argue that that discipline is necessary for the viability kind of society for the long haul as we age, because these folks need some discretionary income as they age, or we'll all be working until 97. And so I really think that's an important shift that must be maintained or encouraged to be maintained.
All righty, fantastic. I have 7 or 8 other good questions sitting right here. We're going to let them go. It is 9:48. We promised 9:45 as a closing time. We're going to wrap up. This is a fantastic job by this whole panel. Let's give them a hand. Special thanks again to our sponsors, Nichols College, and to Bolus Lynch, and to WTAG. And thank you all for coming this morning. Please fill out your amateur economist form, and I think folks will be hanging around in the front of the room for a couple minutes. If you do want to pin someone with that question, please come forward, and thank you again. Fantastic.